Hello traders, good morning, good afternoon, good evening, bonjour, bonsoir, mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW SYS008 traders. The title of the video is how to catch the fifth Elliott wave like a pro. Let's get started. Okay, I have recorded today a video that we call how to catch the third Elliott wave like a pro. You can check it out on our YouTube channel, the 24 Elliott wave YouTube channel. Okay, let's get started. How do we catch the fifth Elliott wave like a pro? Let's remove my drawing on my chart. Okay, pay attention carefully to what I'm going to do here. All right, my trading approach is very simple, combining the technical trading and the fundamental analysis. The old way of trading, when one will use the technical alone, okay, have gone, all right? The fourth Elliott wave, okay, how to catch the fifth wave. So remember, if you want to catch the fifth wave, ladies and gentlemen, what do we need to see first? The first condition is that we must see the first wave, okay, the second wave, the third wave, and the fourth wave. Here it is, okay? Our guidelines that we see: consolidation, breakout, first wave, second wave should not cancel the first wave, provided that the market environment is bullish, the market sentiment is also bullish, the fundamentals are solid in an up move. All right, then we have the third Elliott wave and the fourth Elliott wave. How do we catch the fifth Elliott wave? That's a very good question, all right? How do we catch the fifth Elliott wave? Again, we are talking about Elliott wave, so we must adhere to the wave principles. What is the wave principle telling us? All right? The wave principle is telling us that the fourth Elliott wave must not overlap the first wave, which means what? It means that the fourth wave should not go into the section. Here it is, the section of the first okay, wave, okay, here, you see the first wave from here to here. So the fourth wave should not go down into the range of the first wave. This is a wave principle. So when the fourth wave is underway, in normal condition, it shouldn't come into the range of the first wave. That's one of the theory. But the reality of the market can be messy sometimes, and we need to be aware of it, okay? The wave principle also telling us that the third Elliott wave should not be the shortest wave. Very often, in theory, okay, the third Elliott wave should be the longest wave. Without talking too much, ladies and gentlemen, because we have a lot of video on our YouTube channel where I explain to traders everything. On this chart of Nike, I counted 5 waves. So pay attention. First wave from here to here, second wave from here to here, which is the red line, and the third wave from here all the way here, followed by the fourth wave down to this level. And we can see this is the fifth wave, which is extended. I recorded this video because before I recorded a video which I posted. I was analyzing Nike, and we see this extension. I projected the extension to this point. The price here now, we are at the target price for Nike. Today, I'll be looking for opportunity to sell Nike. I'll be recording another video after this one at exactly 10 a.m. Eastern time. I'll be recording another video when I'll be looking for opportunity to sell Nike because we are at the target price. Okay, so today is the 25th of November 2014. The time in London is 49 minutes past 2 p.m. In New York, 49 minutes past 9 a.m. All right, so we see the first wave, second wave, third wave, fourth wave, and we can see here that we are in the fifth wave, which is an extended fifth wave. All right. The wave theory says to us also that if the first wave and the third Elliott wave are not extended, there's a high chance that the fifth wave will be extended. Now, you say to me, Joe, please talk to me fast, okay? All right. What the professional investors are looking for, when they see the first wave, second wave, third wave, okay, and the fourth wave is underway, If the market environment is bullish, the market sentiment is bullish, the fundamentals are solid, the price will complete the fifth wave. But traders will place orders at 38.2%. You have limit orders to buy at 38.2% of the third wave. So once they see the third Elliott wave, you see this is the third Elliott wave, they will draw Fibonacci retracement here, and they will highlight which level? The 38.2%. This is the first one lying here. Stay with me. And then we'll also highlight the 50% Fibonacci retracement level. Provided that the market sentiment is bullish, the market environment is viable, and the fundamentals are solid, they will do that automatically. They don't wait for signal. They will just place automatically orders to buy at 38.2%, 50%, and they will hide their stop loss below the 61.8% level. So as the fourth wave is trying to go down, it hit the 50%, there will be order to be filled. If some traders try to sell it beyond the 38.2%, prior reaches the 50%, because orders were already littered in that session, these orders also will be triggered, will be filled, and the price will find it very, very, very difficult to go beyond the 61.8% zone, provided that the market sentiment is bullish. Okay, the market sentiment is bullish. Okay, the market environment is viable, and the fundamentals are solid. This is how the professionals are catching the fifth Elliott wave. So if the market, how do we know that the market market environment is viable? The economy data are bullish. Okay, recently we have a bearish season, the financial crisis, and then they start pumping money into the market. Okay, so there is a bit of recovery taking place. Traders, I recommend to traders to look at the stock in Japan, Nikkei 225, and to look for this type of strategy, okay? At this point in time, in 2014, all right? So, if the market sentiment is bullish, market environment viable, fundamental solid, how do we check the fundamental? We go to Google Finance, www.googlefinance.com or finance. You just click on it, Google Finance, put the EPIC in, perform the Google Acid test, do the fundamental analysis, perform the due diligence, check the economy news, are they gaining more market share? What is the management doing? How long they have been in place? Is it the same manager in place that are losing more market share? Okay, have they changed their management recently? All right, some managers have excellent track record. You put them in place, they perform like a donkey. Okay, so are they getting more market share? Are they making more money? Do they have a future? The future is very important. It's not the money that they are making today. You want to buy for the future, yes or no? So look ahead. You are driving, look ahead. All right? What is the future prospect for them? Look at the sector. Check what we call the trading triangle. All right? Remember the trading drill, the trading triangle. All right? Once you have done that, you are satisfied that the market environment is viable, market environment is viable, market sentiment is bullish, fundamentals still in place, strong. We are likely to see the fifth wave, and the fourth wave will find it very, very difficult to cross, okay, the 61.8% zone. That's why they place their stop loss beyond the 61.8, because they don't expect in this environment for the price to be below the 61.8% level. There are many ways that one can catch the fifth wave. I have recorded other video about the fifth wave. Check it at 24 Elliott YouTube channel. But this is another way that the investors, the smart investors, the hedge funds are catching the fifth Elliott wave. It makes sense. It is also powerful. So we are using the Fibonacci retracement level. The level that we are watching, 38.2%, 50%. I recommend to traders to look for, okay, opportunity to buy in that condition, okay, the three conditions I mentioned, to look for opportunity to buy, to allow the price to come to the 50% zone, which it will be very, very difficult. Okay, if you see that, you are very lucky, because the fourth wave is usually very shallow wave. All right, because why is shallow? Because if the third wave is strong, is highly extended, apologies to traders. If the third wave is strong, very, very bullish, they probably find it very difficult. The fourth wave will find it very difficult to go down to 50%. It will stop at 38.2% zone. So traders who are trading the 38.2%, they usually trade, are looking for the fifth area wave, the 38.2% level. All right? If it falls it down to 50%, it shouldn't go beyond the 50%. It shouldn't. In normal, okay, motive wave, strong bullish motive wave, the fourth wave should not go beyond the 50% zone because the fundamental are solid, the market environment is bullish. The third wave has been extended. The third wave is very strong. But sometimes you will see that the fourth wave may go down up to the 50% because the market have a bit of doubt or uncertainty. It's not aligning beautifully. So you will see you dropping down, and you may hit the 50%. But if there's no doubt, everything is clear, everybody is happy, the fourth wave will not reach the 50% level. One example here, you see during I told you that this is the fifth wave that has been extended here. I want to close this video before 10 a.m. Eastern time because I want to day trade. All right, you see here? So 1, 2, 3, 4, 5. This is the fourth wave, yes or no? You can see that during this count, 1, 2, 3. You can see that the third area wave was almost vertical, okay? Almost vertical, okay? Here. And then you see the pullback. It did not go to the 50% of the move from here to here. This is the third area wave. You want me to color it in a different color? Okay, let's color it into green. It did not go beyond the 50% of the move from here to here. So, if the market sentiment is bullish, market environment viable, checking the economy news, okay, the global market, okay, what the central bank are doing, okay, what's the general market sentiment, okay. You go to Google for now, you perform Google acid test, fundamentals are solid, they are gaining more market share. Do not rely on the past data because the fundamental can be a bit tricky sometimes. When traders make a lot of money, it's 5 times money they made last year. But why they make 5 times more money than last year? It can be just one exceptional occasion that make them make that extraordinary, okay, sale. So you want to know why suddenly they are making more money. Okay, is it just once in a while, or is it consistent? Now that money making, okay, does it have a future? All right. So if the future prospers because you are buying into the future, you want to know whether the fundamental that you are analyzing today, okay, can carry on into the future. And very often, if the market sentiment is bullish, market environment viable, okay, fundamental solid, okay, professional will place order to buy at 38.2%, 50% Fibonacci retracement level, hiding their stop loss behind the 61.8% level to catch the fifth area wave. Remember, as the fifth area wave is underway, if the third wave is already extended or the first wave is already extended, okay, if the third wave is already extended, we usually see that equality, the length or the magnitude of the fifth wave is usually equal to the length or the magnitude of the first wave. There is an equality theory between the first wave and the fifth wave, as it was at the beginning, so it shall be at the end. Sometimes things can be a bit complicated, but we cannot cover everything in this video. I will stop here and leave it to you. If you have any comment, put it below. If you dislike this video, give us the thumbs down. If you truly like it, give us the thumbs up. If you really, really love this video with all your heart, your mind, your soul, share it on Google+, share it on Facebook, okay, and enjoy it. Until the next time, enjoy yourself and be very happy. To summarize this video, we are looking for opportunity to buy at 38.2%, primarily 38.2% or 50%, okay, if we want to catch the fifth area wave, provided that the market sentiment is bullish, okay, the market environment viable, and the fundamentals are solid. The opposite is also true if you want to catch the fifth bearish area wave. We want the fundamental to be weak, the market environment to be bearish, all right, and the market sentiment to be also bearish. Okay. All right. We will also analyze the structure of the third wave and the first wave. All right. If neither the first wave nor the third wave are extended, there's a high chance that the fifth wave will be extended. If the third wave is strong and has been extended for too long, there's a high chance that we are likely to see a buy signal at 38.2%. All right? But if there is uncertainty and doubt, the prime may pull it down to the 50%, and we can hide our stop loss at 61.8, below the 61.8% zone. Remember, if during the fourth area wave, the market sentiment is continuing to be bearish, suddenly we have a bullish, and it continues to be bearish, and we enter suddenly the general bearish season, it will continue to go down, go down, go down, go down, go down. Remember, the fuel in the car is the fuel that will propel the stock. So we want, if I say, the green fuel for going up and the red fuel for going down, all right? So we want the fundamental to support our trade. Until the next time, enjoy yourself and be very happy. We are the TSTW S008 traders talking about how to catch the fifth area wave like a pro. Thank you for watching, and we will speak to you very soon.